I'm not going to be able to do justice in the time to the introductions. They're going to be extremely brief, and so hopefully you'll get a chance, maybe if you want to find out more, you can look at the website from Purdue University's Ag Econ Department, all of the vitas of our faculty there, and you'll find out more about the other two in some of the events later, okay? My name's Mike Boehlje, and I appreciate the opportunity to be the moderator of this session. So we're going to just start with the panel comments. Chris Hurt, who is our resident expert, and not just our resident expert, but actually nationally and internationally resident expert on issues associated with supply-demand issues in particularly the grain, but also the livestock markets, an extension economist here at Purdue University. So Chris, if you'd like to start our discussion.
Well, thank you very much, Mike, and great to see all of you here this morning. I wanted to just set the stage a little bit for some of the reasons why we see such shortages in terms of our basic commodities around the world. And of course, we're going to be featuring more our basic commodities of the Midwest and food commodities, but this certainly extends on beyond more broadly into commodities. One of the first things we're going to talk about as a big category are biofuels. And I'm going to talk just a bit more about corn in particular as it impacts the primary Midwest in the United States. But as we look to the entire world picture, clearly soybeans are also being used, soybean oil, for biodiesel in this country, but not nearly to the extent corn is. Sugar cane in Brazil, taking additional land for production of biofuels there, and rapeseed oil in Europe is their primary seed that they have used, oil seed, in order to make more biodiesel. So we'll follow up on each of these, obviously. World income growth, another big category. I'm going to talk about where that really makes a difference here in the Midwest, and that shows up in the form of China and China buying soybeans. I think you'll hear us talk this morning about how the world has responded to these short situations we saw in 2008 and now again in 2011. So how governments have responded and how international trade has been affected certainly is very important. I think you're obviously going to hear about macroeconomics in terms of the impact, what's the dollar doing, the business cycle as we think about the high prices in 08, major recession, then late 08 and 2009 U.S. and world, and then recovery now and how that's affected these prices overall, and obviously inflation. So let me just make a few direct comments about supply and use. So when we look at supply and demand, clearly as we think about prices, when we see demand growth very strong relative to supply, we see inventories or stocks really drawn down. So we see that in the world at this point and clearly in the United States. Corn is the very shortest of our commodities, of our agricultural and food commodities. Here in the United States, we are dealing with real concern about the ability to get through this summer with the old crop inventories that we have. USDA is carrying an 18-day supply of corn, and that is at the end of August this year. We normally, in the primary Midwest, are not into harvest, a major harvest of corn until very late September and October. So you can see that is really perhaps desperately short situation. Soybeans at the end of August, USDA is talking about a 15-day supply of soybeans in the United States. So again, these are dramatically low numbers when you think about a 365-day year, and as we get near the end of one crop, we're down to just a few weeks of supply. We have to renew that supply. We have to renew that 365-day supply. So it obviously puts tremendous pressure on getting good yields in the U.S. as well as the world this year. Now, wheat, we're in better situation in the U.S. and the world, 125 days supply in the U.S. of wheat, and you would tend to say, well, there's no problems in the wheat market. Our problems there are really weather problems, and that starts with hard red winter wheat out on the plains. That's a little under half of the wheat we raise in the United States, and there really is drouthy conditions. Kansas, our largest state producing wheat, 37% is poor or very poor, rated by USDA. Those are the lowest two categories. 37% of that crop in real trouble. Oklahoma, 60% poor and very poor, and Texas, 66% poor and very poor. The largest state and very major states in Oklahoma and Texas. In contrast, soft wheat that we raise in the eastern Corn Belt only represents about 15% of the U.S. production. It's in great shape. Missouri's one of our big states in soft red winter wheat, 70% good and excellent. Illinois, 60% good and excellent. Indiana, 57%, and Ohio, 69%. The unfortunate part is the big wheat harvest is out there in the central and southern plains, and that's really in trouble. Okay, as we look at these big drivers, I'm just going to talk about three. First, talk about corn and its relationship to ethanol and what has that tremendous growth that we have seen in these last 5 to 7 years. I'm going to go back 5 years, and we look at the whole world picture. 59% of all the growth in corn use in the entire world over the last 5 years, from the 05 crop to our 10 crop, 59% of the growth in corn usage has been in a category where ethanol would be placed, industrial use. World data, we don't have that broken out specifically for ethanol, but that would be the big increase. Here in the United States, over the last 5 years, 100% of the increase in corn usage, this big demand growth that we've had, is for ethanol. That represents 2.2 billion bushels of corn, and when I'm talking about these bushels use, I'm adjusting, taking out the distiller's grains. So about 2/3 of the corn, the starch, the carbohydrate in the corn, is used for ethanol production, and then about 1/3 of that corn comes back as feed. So I'm just looking at the ethanol use portion. That's 2.2 billion bushels of corn in the last 5 years. As we go back and look at just the corn, the portion of the corn used for ethanol, in 2005 it was 13% of our U.S. corn crop. Today, that's 25%. So that's a huge, in a very short period of time, huge increase. Now, you'll hear the USDA and other data quoted as 37% of our corn crops going to ethanol. Why am I using 25? I'm backing out the distiller's grain. So we've gone from 13% of the corn going for ethanol to 25%. Put that on an acreage basis here in the United States, that's an additional 14.5 million acres of land that it has taken to raise that corn, and I'm adjusting for the taking the distiller's grains out. Second big thing, world income growth, China in particular, and that is a 19% increase in total world usage of soybeans just in the last 5 years. China's 60% of all that growth. They have more than doubled their purchases of soybeans, and when you look at that chart, it is just going vertical, the amount of beans that they have bought. And that, on a bushel basis, is about 1.1 billion bushels of additional world purchases. When we look at the United States, what beans we were supplying to China back in 2005 took about 8 million acres. That demand for China today is about if I can find my numbers, 20 million acres. So that's about a 12 million acre increase. So two big things going on, and they're centered right here in the Midwest, corn and soybean country. And that is the increase in acreage going to corn, about 14 million, and going to soybeans, 12 million. That's 26 million additional acres have been required to try to meet those dual huge increases in demand in a very short period of time. That's about 10% of our non-hay base here in the United States. So essentially, without an ability to get more land in production, that really has taken up a lot of shifting of acreage over to corn and soybeans. Then weather has been another big factor this last year. We look at total grain production in the world. We dropped about 53 million metric tons this last year. That started with the Russian drought problems back last summer. It extended to poor wheat production in Canada. We then saw the corn crop in the United States get in trouble late summer, and we ended up being about 7% lower than we expected on corn production. That extended on into South America, Argentinian problems, particularly in January on corn, and Australian flooding. So we've had quite a long list in the last 9 months of problems. If the last time we had some shortage on crops, these total world loss on crops and total grains was about 40 million metric tons. This last year was 53. So we really do have a pretty big supply issue. On the other hand, when we project out normal weather this year on world crops, that with normal weather, we would still have to increase our acreage worldwide by 2% just to maintain stocks at the current level they are if we have this continued trend growth in demand. So I think what that says is it's in 1 year, this next year, the 2011-12 year, we're not going to be able to replace world stocks and build those. We may make some progress, but we're going to have very strong agricultural commodity prices continuing for the next year. We're just not likely to be able to build those stocks back. Mike, thanks a lot.
Thanks, Chris. Thank you very, very much. We'll get a chance to ask him some questions. Now, deeper dive in the energy area. Wally Tyner, again, nationally and internationally known for his work in the energy field generally, and particularly in terms of biofuels. Wally.
Thanks, Mike. Well, I only had 3 or 4 points to cover, and Chris already covered one of them, so I'll try to focus on the rest. As Chris indicated, there's really no doubt that with a quarter net of the corn crop going to biofuels, that it has an impact on corn prices. So let me focus more on policy and volatility in the short run and then switch to the long run. The policy environment for biofuels, we started subsidizing ethanol in 1978 with the Energy Policy Act of 1978. And the subsidy ran from 40 to 60 cents a gallon from then up to the present. And so up through 07, 08, biofuels growth was driven mainly by government policy, which was the subsidy, and by oil prices. The combination of those led to a very slow growth from the early 80s to about 2003, and then when oil prices took off, the combination of the subsidy and the oil prices led to a boom in the ethanol market. But in December of 2007, we passed the Energy Independence and Security Act, which created a renewable fuel standard that became binding, meaning that it became a big driver in the market for ethanol, for corn ethanol. And now that renewable fuel standard mandates 12.6 billion gallons of ethanol be blended. And what a mandate does is it says it doesn't matter what the price of corn is, we have to blend enough corn to produce 12.6 billion gallons of ethanol. Now, normally you think of demand as being responsive to price. Corn price rises and we feed less livestock. Other people in the consumers respond by lowering consumption. But with a mandate, that doesn't happen. It's demanded, the government, it is the law of the land that that much corn be used for ethanol. So in economic terms, what that does is it makes the total demand, with 40% of the corn going to ethanol, it makes the total demand much more inelastic, much less responsive to price changes because that portion of the demand is fixed. Now what that leads to is anytime you have either real or perceived supply shocks and a demand that doesn't respond, a supply shock that's negative, meaning less supply, is going to shoot the price way up, much more than it would be without that fixed mandated demand. And so you're going to have higher highs and lower lows, more volatility, because you have changed the nature of the corn demand due to the government policy of mandating a large fraction of the corn crop to be in ethanol. So the largest short-run impacts are the level that Chris talked about of the price and the increased volatility that's due to the nature of our policy today for ethanol. Now, the long-run picture is quite a bit different. Historically, in the long run, when we've had price increases, producers around the world here and in the rest of the world respond to those higher prices and produce more. And I at least would expect that same pattern to continue. As Chris indicated, it's not going to happen in a year, and maybe it won't happen in 2 years. But there is, particularly in the rest of the world, in the United States, if you compare yields on test plots with the yields that farmers get, the farmers' yields are maybe 20% or a little bit less than the test plots, but they're relatively close. But if you go to Eastern Europe, the gap between what the test plot yields are and what farmers get is more like 40%. And if you go to Africa, parts of Africa and South America, it's more like 60%. So there's a huge gap between the potential and where farmers are today and much of the rest of the world. And these higher prices are going to help stimulate more production. They're going to help overcome some of the obstacles, and there are a lot of obstacles. There are credit constraints, there are market infrastructure constraints, there are fertilizer availability constraints. But the price signals, if they get transmitted, and Phil will probably talk about the extent to which they might get transmitted to farmers around the world, will, I think, over time induce a price response. It won't bring us back down to where we were historically, but it will bring prices down from where they are today. So the bottom line is, in the short run, we have these two major impacts, higher levels and higher volatility. In the long run, we would expect a supply response from the rest of the world, bringing prices down and increasing supplies, at least to some extent. Mike, I'll stop there.
Okay, thanks, Wally. Appreciate it very much. Wally did introduce the concept of what's the global impact of this and the linkages and transmission across borders into other parts of the world and back into us. Phil Abbott is again recognized and renowned for his work in international trade and global economic issues. And so, Phil, let's talk about some of these global dimensions.
Okay, thank you, Mike. Chris told us a story about shocks in demand to the system and some shocks in supply that help to account for why prices are high and volatile now. Wally told us explicitly a story about why the markets are more inelastic and adjust less to price changes than they have in the past. And Chris has a story he didn't tell because he didn't have time, I presume, about what's going on in livestock and feed markets that also contributes to this lack of adjustment. It was expected when the discussions about biofuels policy first occurred that much of the adjustment in the agricultural markets would occur in the export market, that international trade would reduce to accommodate the increases in demand, okay? And that hasn't happened, and what I want to talk a bit about is why that's the case. I need to just preface this by saying the two issues I'm going to talk about were considered critical issues in explaining the price spikes in 2007 and 2008. The word on the street is these aren't as important this time around, and I want to tell a cautionary tale that we ought to be paying attention to these issues nevertheless. And the two stories I have to tell are what's been happening to the exchange rate, why the dollar's so weak and how that affects markets, and how countries respond with their own policies to try and cope with what's going on in international markets. And I'll take the second topic first, and I'm going to leave some of the first topic to our other speakers, but we'll say a couple things about it. Most countries in the world responded to the food crisis in 2007 and 2008 by trying to stabilize their domestic markets and try to isolate themselves from what was going on in international markets. The most egregious responses now, we believe, were exporters who banned export of grain into international markets. Some of my colleagues claim that you can entirely explain what went on into world rice markets by export restrictions of the various rice exporters. The rice market is a thin market. There's relatively little international trade in it. And one by one, the big traders in rice closed their borders, and rice, where there was no real evidence supply or demand shock, saw prices increase substantially more than any of the other commodities. Isn't happening now because there hasn't been a shock to rice, and so far those traders haven't started to close their borders. Wheat's a little bit different. In the wheat market, Russia, the Ukraine, Kazakhstan, and others in Argentina closed their border in 2008. Because of drought, Russia has this time as well. Ukraine has been more disciplined, and instead of banning exports, they put a quota on exports. And Kazakhstan has kept their border open. So we haven't seen that effect yet in the wheat market. One of the things that's sometimes lost in this discussion is the way importers behave. The countries I just mentioned are big traders, so you can see individually that they have effects on the world market price. There are lots of importers, most of whom aren't big enough traders to influence the world market, but the collective action of those importers, if they restrict trade, could essentially make trade not adjust and more volatile, and could help contribute to why prices went up so much. And in fact, most countries did what they could to try and isolate their markets and prevent themselves from seeing the effects of this, and of essentially stabilizing their own markets at the expense of making other markets less stable. Evidence of this is in 2008, when prices last peaked, the quantity imported of wheat, corn, soybeans, and rice all hit record levels. It wasn't just value because of the high prices, but quantities were high as well. Nobody was cutting back. And this time around, we saw a big fall in imports, not because of the high prices, but because of the global recession and a collapse in trade that accompanied it. And we're seeing those records being approached yet again, with the only exception being the market in corn, where exports are up since 2009, but they haven't reached the 2008 levels yet. There are two discussions that follow from this issue that have reached the level of the G8. Under the French presidency and the G8, both stabilization policy by countries and whether we can solve this problem internationally so countries won't do it by themselves is being discussed, and the possibility of introducing export restrictions into the WTO agenda are being discussed. It should be noted that at this point, what everybody did to protect their domestic markets in 2008 did not violate any commitments to the WTO. Understanding Chris's story about China and the soybean market, and why China plays a very different role in, say, wheat and rice markets, and why we're debating what's going on in corn markets, also follows from this. China isolates their wheat and rice markets, and they leave their soybean market open. They have dramatically different trade policies, and that has a dramatically different effect on how international markets behave. At least in wheat and rice, China trades almost nothing, and they may have large production, and they may have large stocks, but neither of those touch the world market. I chide Chris because everybody in his business always uses world production and world stocks, and there's a lot of world production and a lot of world stocks that really don't affect international markets. International markets tend to be thin. Lots of countries are largely self-sufficient, and it's only the big exporters who really leave their borders quite open. Okay, let me just talk a little bit about the other topic, which is exchange rates. Another reason why the international market doesn't adjust is if the dollar is weak, if for us foreign currencies are expensive and for them dollars are cheap, the prices that we see aren't as expensive in other currencies. Chris, Wally, and I wrote that was a big deal in 2008. People seem to think it's not such a big deal now, but by my reckoning right now, the dollar is still relatively weak. More importantly, I think the dollar is a proxy for other things going on in the macroeconomy. There's a relationship between the dollar and prices in commodity markets that isn't well explained by our basic theories and suggest that other macroeconomic factors matter. For example, I believe that one of the reasons the dollar got so weak in 2008 was we were fighting recession, and the Federal Reserve had cut interest rates dramatically starting in August of 2007, and the European Central Bank didn't start doing that until July of 2008, and that's when exchange rates changed directions. And that's important right now because something that's probably not greatly appreciated in the audience but is by one of our other speakers is the European Central Bank started to raise interest rates this week. And we're going to see how that's going to affect exchange rates. But clearly exchange rates affect the prices of our commodities as faced by foreigners. They make them cheaper to foreigners. A weak dollar has always been good for export commodities like U.S. agriculture, and this is clearly one of the factors driving where we're at now. Okay.
Great. Phil, thank you so very, very much. Appreciate it. Next, Ken McCorkle, who is Executive Vice President for Agribusiness Industries of Wells Fargo. Ken will be receiving an Apex recognition for the collaborative work that he does with us at Purdue here in some of our executive education programs. And I think, Ken, you're going to be talking some from a financial perspective about some of the risk and the challenges that we see in the market right now. Ken?
Thank you very much, Mike. It's interesting. One of the things Mike didn't mention is that I'm a food scientist, not an economist. And so I'm a little bit out of field in talking about economics, but having prefaced it that, I'm going to do it anyway. It's interesting. In the last 2 days, I was at an Informa conference. The president and CEO of Informa is a Purdue graduate by the name of Bruce Scheer. And one of the speakers was a World Bank economist. And he made the comment that as soon as we get stocks back to normal, price volatility will be more like historically it has been. And he went back to use data from the 1940s and 1950s. And I looked at him and I said, how would you use that kind of data? Because in those days, the government was buying and selling commodities that maintained a stability level that just doesn't exist any longer. So I'd like to make 3 points. I'm going to address the financial implications of commodity price volatility, but I want to make 3 points, and some of this is going to overlap. But because I believe that commodity price volatility with an upward trend in prices is the new norm, I want to defend that argument in case anybody else up here feels that we're going to return to a more stable environment. I think the reason for that is really there's been a transformation from surplus to tighter supplies, which has already been addressed, but it's primarily a result of structural changes on the demand side. Obviously, population is growing, that's been addressed, but that creates a steady upward pressure on demand, and so we need to grow the supply at least as fast as the population growth to maintain a buffering carryover stock of various commodities. Secondly, and again it's been addressed, but this global income growth, again at this conference in Washington, D.C., the chief economist for USAID made this comment: over the past 15 years, we've made the most rapid reduction in world poverty in the history of the world, which suggests now there's plenty of poverty still, but the fact of the matter is there's a lot more income than there has been at any other time in the history. Unlike population growth, though, economic growth is cyclical and erratic. So we have this uneven pressure on demand, where in the case of population growth, it's kind of a steady increase in demand for products. The third is government policy. Again, it's been covered to some degree, but in my mind, that is as unpredictable and as erratic as anything. The government policy considerations, again, they've been talked about, the trade policies restricting exports and imports, a monetary policy which impact the relative currency strengths and exchange rates, and of course the mandates that once again have already been addressed. But you can't mandate and subsidize the burning of 25% up to 40% of your corn crop without, and also 55% of Brazil's sugar crop, without having a major impact on the commodity prices. The transformation also is a function of some supply issues. There are limitations on new acreage, particularly with adequate water supplies. There's a lot of land in California. Everybody talks about we can't cover up the land in California, but the fact of the matter is that land is not the limiting factor. It's the amount of water available to irrigate that land. There's some questions on the rate of increase in crop yields. Hopefully, genetic modification will allow us to produce more on the land that we do have under production. But, of course, that's got some regulatory issues associated with it. So there's questions on whether we'll be able to rebuild the historical stock-to-use ratio, in my mind. And that means that production variability as a result of weather and disease is going to have a more magnified impact on commodity prices going forward. Now, there is one positive out of all of this, and that is the degree to which we encourage world trade, free world trade. That creates a more diversified supply for the world. And so all of us should be thinking in terms of reducing import and export restrictions in terms of stabilizing prices overall. Let me move to the topic that I'm really supposed to be addressing, and that is what are the financial implications of this? Well, the first thing that increased commodity price volatility does is it increases the operating risk of all agricultural businesses. If you think about the risk profile of a business in terms of a probability distribution of the cash flow, then what this does is it flattens and extends the tails of that cash flow distribution. So that's the risk opportunities, or the opportunities for more gain are there, but the opportunities for a greater loss are also there. Now, the most vulnerable operators in that kind of an environment are those that are unable to either fully hedge or utilize other margin management tools. And these would include folks like the dairy industry, the poultry and egg producers, fertilizer distributors, feed manufacturers, meat processors. The dairy industry is a particularly interesting one because for years you had a government support price in place. You had relatively level, non-volatile feed costs, and all you had to do to make money in the dairy industry is be a low-cost producer. In about 1995-96, the milk prices started becoming somewhat more volatile, and in about 2003, feed costs became a little more volatile, and by 2007, they became a lot more volatile. And so now you've got, and then on top of that, you had the biofuel mandate. And so now you have the two aren't tracking. The milk prices are not tracking with feed costs. And unfortunately, most dairymen remain locked in the idea that all they have to do is be low-cost producers, keep their cost of production down. There's an old saying in the milk and the dairy industry that if the price is low, you expand. If the price is high, you expand. And that hasn't really changed very much. So the second thing that it does is if you have a higher risk, increased commodity price volatility, it increases the capital requirements of the business. Obviously, the inputs or the commodities are more expensive to purchase. The risk management tools are more expensive to purchase. Futures contracts are higher. Options costs are higher in greater volatility environments. Insurance costs are higher. It also increases the capital requirements to buffer the company from the downside risk that we talked about. Banks tend to lower advance rates when commodities become more volatile, and appropriately so. And so that requires more equity in these agricultural operations. Increased commodity volatility also adds complexity to properly sizing your line of credit. If you get it too small, and suddenly you have a run on your prices, you're going back to the bank just at an absolutely inopportune time. You've got to have additional capital to meet your margin calls, and your line isn't big enough, and you're negotiating from an incredibly weak position when you go to that bank. On the other hand, if you set up a line of credit that's too large, you're paying for unused availability if the price doesn't move. Finally, it has increased commodity price volatility has some psychological impacts. There's a temptation to abandon sound risk management practices to conserve capital. We've had a number of companies that had wonderful policies in place in terms of their risk management practices, but when they ran short of liquidity, they said, well, okay, now we've got to shortcut the process to some degree. Let's abandon our risk management practices temporarily, and of course, it always seems that it happens right at the most inopportune time, and they lose a lot of money in the process. In the capital markets, there's a hesitancy to invest capital given increased uncertainty. The potential return to buyers must be higher to compensate for the additional risk. And conversely, the multiple of EBITDA among acquisitions has got to be lower to generate a higher return. Finally, this is the third point, increased commodity price volatility is leading to some creative credit solutions to help borrowers meet their liquidity needs. The first of these I want to mention is over-the-counter swaps and exchange for risk products. These I'm not going to get into any detail on, but basically the borrower locks in the price of their agricultural commodity. The bank takes on the margin call responsibility, and the customer knows in advance the exact cost of financing their risk management activity. A variation of this is called Repo Financing. In that case, the bank purchases the inventory from the customer. The bank actually owns the inventory, and the bank accepts the in-place futures contract or the hedges, and then the bank contracts to sell the commodity back to the customer at a fixed price on a fixed date. And those are typically 90 to 180 days later. For the operator, once again, this eliminates the uncertainty of margin calls. The borrower locks in a known financing cost in advance. The borrower pays no margin calls. There's no risk of running short on his line of credit, assuming he sized it properly in the first place. And there's no need to pay for an oversized line of credit for that excess availability. So just quickly to summarize, commodity price volatility in my mind is the new norm. Commodity price volatility increases the operating risk of agribusinesses. Increased operating risk requires increasing the capital intensity of the business, and there are some creative tools out there that may help operators manage this risk. Thank you.
Well, thank you, Ken. For a non-economist, that seemed to me to have a pretty good reflection of what economic concepts and principles do to influence an industry. What Ken didn't share with you is that not only his pragmatic experience in the Wells Fargo organization has been able to give him that perspective, but he did in an earlier career spend some time at Harvard and actually was a case study writer for Ray Goldberg, so that may have influenced him just a little bit as well, okay? So finally, we're really pleased to have this afternoon as our speaker at the Snyder Lecture, Dr. Thomas Hoenig, the President and CEO of the Kansas City Federal Reserve Bank. We have asked him if he would be willing to make a few comments here at the close of this panel. We are sure that he isn't going to want to tell you everything that he would be telling you this afternoon, but I'm fully expecting that he has some reactions that he'd like to share with us. Thanks for being with us, Tom.
Thank you, Mike. I should start out by saying I guess that's an introduction to a trailer. I'm doing the trailer for this afternoon's program.
Sorry.
I also need to let you know, since I'm at Purdue, it's required, I guess under some rules, that I disclose that I am an Iowa State graduate, so you have to, so be careful. I'm delighted to be here. I've already learned a great deal from the other panelists, but I want to start out by saying that regardless, Purdue, Iowa State, I do believe that markets work. And the idea that we have this global market and that we have events, droughts, we have changes in technology, they do affect the market and the market adjusts. So then the issue for me as a member of the Federal Open Market Committee on Monetary Policy is how do you allow those markets to work best? And that's really a difficult issue right now, because if you've been listening and watching some of the discussions among the members of the committee, there is the issue of whether we have an inflationary impulse that's reflected in these commodity prices? Or do we have really the market working and we're having a shift in relative prices? And therefore, the market will adjust, the prices will become normal, whatever normal is, and the economy will move on with this. Or are we and our policies providing, if you will, the fuel for an inflationary impulse that then takes forward? And what I am concerned about in a couple things are that given where we are in the recovery, that the Open Market Committee continuing to be in an easing mode during this recovery, we are setting the conditions, if you will, for inflationary impulses to go forward. And if you read this morning's paper, you see a sense of that in China, which is a major partner in this sense in terms of our world markets, because they are now in the midst of their own inflationary issues and debating those because they are in an inflationary situation that affects relative prices to the United States, but also affects price levels because the United States is the international reserve currency, and we have been easing into that, thus fueling a broader inflationary impulse perhaps. So what I worry about then is that monetary policy may be feeding this. I think it is, and that will complicate the market's ability to adjust. You see it in trying to determine how much of the price movements we're seeing in commodities, but now also in a broader group of goods and services are really market adjustments, relative prices, or how much of it is systematic increases in inflation. And I think that shift is taking place. It's becoming, if you will, fueled by the monetary policy. Now, that affects prices that we see in the commodities, and it gives the producers, if you will, a sense of continued price increase for as far as they can see. And that causes you to make decisions around production, around how much you're willing to invest, how many others are willing to invest in that production process, and we're seeing that going on in the world. And perhaps for me, one of the most, I guess, events that I'm watching most carefully is this whole issue around land values, whether this is a natural increase given world demand or whether this is being the beginnings of a potential land value bubble, if you use that word. And the way I say that is, as was mentioned, as price increases are thought to be more permanent, you tend to raise the price of the land, the production input to that. And that will adjust if the prices come down, of course. But when you then have, with that, a very accommodative monetary policy to where, in fact, your policy rate is zero or very close to zero, and you're driving down the interest costs, then you have two effects. One is, as you know, whenever you lower the interest rate or the capitalization rate on an asset, you increase the value of the asset. So we're pushing that value up with these very low rates. We're pushing then the value up even more because if it's inflationary pressures that are bringing these commodity prices up, we're increasing the value of the land thought to be. And people begin to see that, and they then, secondly, begin to borrow or leverage the advantage, taking on more debt, both for production but also for land. We've seen it in some of the lending that's going on in the farm credit system and elsewhere, and that creates then further momentum for that value to go up. So what happens if you let that go on for an extended period? What happens when those interest rates then finally adjust? So if right now some of the estimates I've seen on interest rates for land are 3 to 4% lending, and the normal rate is 7 to 7.5%, when that rate readjusts, when we renormalize, then the value, that downward pressure on that has to take some pretty dramatic, will have some pretty dramatic effects. I was involved in the ag crisis of the 80s in our part of the country, which is the Midwest West. That is Missouri, Kansas, Nebraska, and it was really quite devastating to see the collapse of farms, the loss of value, the loss of income. And so I'm looking towards the long run. I don't think anything goes up forever. There will be adjustments, and how we, the monetary authority affects that is extremely important. markets work. But we can also extend, if you will, the boom, and therefore make the bust more difficult. And that is my concern. So I'll end with that.
Thank you very much, Tom. That's really going to, I think, set up the opportunity for a really, really good discussion, dialogue, and interaction. I'm going to come back and ask you a question about that in just a second, but what I'd actually like to do to kind of start the conversation is bring in some of the new information that I think, Chris, you've actually been able to capture relative to the issue that was raised about inflation. You brought out this morning, you were sharing it with Tom this morning. I hope I don't mind that I call you Tom.
No, that's my name.
What happened? Okay. Some people
Don't
like
call him Ralph. Call him Tom.
Right, good. Glad I didn't get that messed up.
I say that because I was on a panel the other day and I kept calling the gentleman next to me the wrong name, the whole panel. It was very embarrassing at the end of the day, I can tell you.
You've got, I think there was released this morning of some price inflation information from Fed. Is that right,
Sure.
Chris?
Yeah, Joe, I'll be glad to respond to that.
Thank you.
You started this. CPI was out today, and again, that's a monthly update. And essentially, one of the benchmarks that the Fed looks at is the core rate, and that is the general inflation rate without food and without energy, the two highly volatile sectors. Now, again, food and energy, that's what we're talking about today. Those are the commodity markets. Those are the ones that are really being driven up a lot. But the core rate, this is just the monthly rate, March compared to a year ago, just 1.2%. It was 1.1% last month. That would have been February. And basically, since the middle, going back to about March of 2010, that has been 1% or lower, and has just gotten up to 1% in January, February, and March, now 1.2%. So I think you have the argument from the general Fed's position that there is no inflation, and continuously, I think if you eat food, you notice that there is inflation. But that's not reflected in the core. The food inflation was up to 2.8%. Again, USDA's projections are 3 to 4% on food inflation this year. Our tendency here at Purdue is to say that we probably will push that on up to 4 or maybe slightly over 4%, at least at times we'll be up in that. Energy, the big driver, the energy as a special index up 15.5% this month versus a year ago. So again, what we're talking about today is the exact thing, Mike, that we have lots of upward price pressure. The numbers for China out today, food inflation 11.7% in the first quarter. Almost 12%. General inflation, as Tom mentioned, 5.4% in China. And certainly their central authorities are saying that is something they're going to address.
Thanks, Chris. Appreciate it. Just some current update of this whole phenomenon. So I'm going to go back to you just a second. Sure. In this conversation. It's
Tom.
To Tom, yeah.
Not you.
We really got this thing going now.
The Fed officially, I think, has some different perspectives on the critical issues of inflation than I think I heard you express, and I think you've been quoted more broadly on that. Can you help us, without revealing anything inappropriate, why is it that they see these inflation things from a different viewpoint than, say, you might have, or than some of the numbers that we're talking about here might suggest? They seem to see either the same numbers or different numbers that are giving them a different message.
The answer to that is I want to raise rates and they don't. So that's a simple answer to it. I think it's an error to look at just core inflation, except in a very short period of time. Because the idea of core inflation versus total inflation is that food and energy are more volatile. That means they go up and they go down very dramatically. And therefore, you don't want that noise in your judgments about what policy should be. So you take those out and you go to the core, which has effects from those in it, but it takes on those effects more slowly and washes them out over time so that you get a better reading over time. The difficulty with that is it requires that they go up and that they come down very rapidly, and that's not been the case. They've gone up, they've come down, but they've tended to go up more quickly. And if you look at the level index of core and the level index of total, you see them both going up and that the total is kind of moving away from the core. And so that tells me that, yes, they should be included, and we are seeing inflationary impulses. And it is more than just this is why I emphasize relative, it's more than just a change in relative prices. That's true, but it also reflects inflationary impulses that are driving things. And when you think about it, if the world's is awash in liquidity, and it is, including China and Europe and the United States, and you are seeing incomes grow in the globe, and that is being pushed by inflationary impulses, then you are going to get sustained total increases in CPI that you need to pay attention to. And you need to take that into account as you look at your monetary policies. And I don't mean just in the US, I mean globally. So that's where I think we need to look at the broader index more carefully now than we have in the past, and react accordingly.
Thank you. Thank you. Yes.
Tony,
Yeah.
can I follow that up? You mentioned the importance that the U.S. currency has as the international standard. That wasn't what you called it. But my question is, how real is the risk that we might lose that status?
I don't see the risk in any kind of time frame that we'd want to talk about. I mean, a generation even. That the U.S. currency would become other than the world's reserve currency. Now, why is that, though? Well, number one, I tell people, especially universities, that it doesn't matter. You may not be really the best student, but if you're grading on the curve, you do pretty well sometimes. And when you look at the U.S., we're not doing particularly well, but compared to everyone else, we're an A student here, and that's not necessarily a compliment. So the point is that we are still the largest, we are the largest economy. We're the most reliable economy. We have the greatest market. We have the greatest rule of law. So we have the most integrated economy, which is our advantage over Europe, for example. So I think the likelihood of us continuing as a reserve currency is pretty significant. Now, that's a privilege, actually. We benefit from that a great deal. Sometimes we don't think so, but we really do. Our credit, we are able to have a deficit that no one else could have on a sustained basis, to have debt levels that are, now, that's not necessarily a good thing, but it gives us time to make the adjustment without a crisis if we choose to do it, for example. We also are, things are priced in dollars, so we have a clear idea of where things are. So it's a real advantage. Now, if you don't manage your economy well and you have an inflationary episode or whatever it is, then you will harm your currency and over time, and nothing lasts forever. And I always tell people the currency that was the global currency before the dollar was the pound. It isn't the reserve currency today, and that's not by accident. So think about it as you think about your policies going forward. And that's why I'm very concerned about inflation, very concerned about debauching our currency or devaluing our currency, not in necessarily international terms, but in real terms. And it's extremely important that we not let that happen. So,
Bill, you look at these issues. React to this question.
Well, so I was going to ask a specific question. You implied in your comments that our inflation will spill over onto China. And my simplistic understanding is that China and other developing countries have pursued somewhat different strategies to cope with the recession that we've been in, that they came out of it much faster and they grew much faster. And a lot of these issues are sort of domestic issues in their economies more so than they are a consequence of what's going on with the U.S. And I guess the other side of your argument would be, well, they could fix some of that too if they change their exchange rate policy, if they're not going to. Could you elaborate on why you think sort of U.S. inflation might spill over elsewhere? And
Sure.
a little bit on sort of this difference in the strategy we've taken to macro policy versus the rest of the world, and whether you think that's wrong, because you're advocating to essentially remove some of the stimulus from the economy.
Right. Well, let me begin by saying that I don't think the policies are very different around the world. I think it mostly is stimulative. China just was more aggressive early on, and now they're dealing with that. It's called inflation. I think it's great that they came back more quickly, but now they have a whole new set of issues they need to deal with, and that's fine. I mean, that's their choice. On the second point is, it's a hard one, but I would go back. If you're the reserve currency, and you're the largest economy in the world, and you keep interest rates, and I'm talking now 2002, 2003, 2004, very low, with what goal do you have in mind? To stimulate consumption. To stimulate consumption. And in fact, it worked. The percent of GDP, of consumption as a percent of GDP went from about 66% or so to 70%. Now, it just so happens that China was in a growth mode as well, and fixed exchange rate that they wanted, and they were benefiting from that, and we were willing to buy. We stimulated our economy dramatically, and we were willing to buy. So we then shipped a ton, literally, of money into China. So China now has reserve currency. They're building plants. They're building this. It's wonderful, and demand is increasing, and they're fixing it. Now, I would agree, they should have been on a flexible exchange rate. Their economy would have adjusted, but they had goals, but they chose not to. But who was pursuing the easy policy and the stimulative policy at that point? Was it China? Maybe, but it was certainly the U.S. So you were pushing this reserve, this purchasing power out into the system. Now, some of it they used to buy goods in the international and pay for them. Some of them they bought foreign direct investment in the United States where we would let them. And they bought a ton, again, literally, of U.S. government securities. That kept interest rates down. So that then reinforced our own stimulus going forward, because normally you would have had a reaction to that in terms of your own demand for those currencies. I mean, for the U.S. debt would have been less. Your interest rates would have gone up. But by recycling that back, that kept interest rates low. And therefore, you fed on it, and therefore you have inflationary impulses going forward. How long can you do that? I mean, now we're here again, where the world's in awash in liquidity. It's looking for places to go. And we're seeing it in asset values. We're seeing it in prices in China. We're seeing it in issues in Europe. So we need to be thinking about the longer term consequences of today's actions. And, it's interesting. I was in South America, and I had an opportunity to visit with one of the central banks down there, and they were saying, because actually South America so far have done pretty well in this crisis period, and they were saying, we do post-mortem kind of analysis of what we did during a period and what we learned from it, because they've had many bad experiences to learn from, but they're willing to do it. That's something we have to do as well. So what did we do in the early part of this decade? What were the impacts? What do we learn from it? And how do we go forward from here? And that's really, I think, part of this issue of how much stimulus and how to pull it back now that's really confronting all of us.
Ken, one of the things that we had a conversation last night, you were talking about, given the stimulus initiative and the funding that's being put out by the Fed, about what that's done to your reserves in your bank. You might want to share that and what's happened and why that's happening to you, why your reserves are building up.
Okay, I was talking as the banking system as
Yeah,
opposed to
right.
just Wells Fargo, but I believe it was in August of 2008, the excess reserves that banks were holding were sitting at about $2 billion. Currently, they are sitting, this is all the banks, are sitting at $1.3 trillion. And if quantitative easing goes as scheduled, they will jump to $1.6 trillion. And of course, many folks out there say, well, the reason for that is banks aren't lending money. That is really not the case. We are all, JP Morgan just came out with their earnings, and the big concern everybody's got is you're not growing your assets. And so everybody's out there competing for the available demand, but the fact of the matter is the demand is just not there. Part of that has been that we've been in an economy that there's been great uncertainty and people are not making the investments. People are deleveraging. Everybody's been talking about deleveraging. We've seen that, so it's very difficult to build bank assets when people are not borrowing. So that's sort of the nature of what's going on right now.
Okay. Bill, just a second. I want to pull Wally in here just a second. You're just too quiet, Wally. We got to get you.